Welcome to the Property Wealth Podcast. In this episode, we're diving into a really interesting topic that can help you diversify your investments and potentially grow your wealth over time.
Absolutely, Sarah. It's all about exploring how REIT ETFs can be a smart addition to your portfolio, especially for those of us over 40 who are looking for long-term stability.
Right. And I think a lot of listeners might be wondering, what exactly is a REIT ETF?
Great question. It stands for Real Estate Investment Trust Exchange Traded Fund. Essentially, it's a way to invest in real estate without actually buying property, which can be super appealing.
Yeah, and there's just so much to unpack here. We'll discuss how these ETFs work, their benefits, and maybe even some risks to watch out for.
Exactly. And we'll also touch on how they can fit into your overall investment strategy. It's all about making informed decisions for your financial future.
So, whether you're a seasoned investor or just starting out, there's something for everyone today. Let's get into it.
Sounds good. First, let's break down the basics of REIT ETFs. You know, Sarah, when we think about people over 40, a lot of them are starting to really consider their retirement timelines, right?
Absolutely, Mike. It's a critical time for many, and the decisions they make now can have a huge impact on their future, especially with the economy being as unpredictable as it is.
Exactly. I mean, just look at inflation. It's been a hot topic lately, and for those nearing retirement, the value of savings can really diminish if they're not invested wisely.
Right, and that's where something like REIT ETFs can really come into play. They offer a way to invest in real estate without having to, buy and manage physical properties.
Yes! And that's so appealing for someone who might not want to deal with the day-to-day management of a rental property. I remember talking to a client, let's call him Dave. He was in his early 50s and had a decent nest egg, but was worried about market volatility.
I can see how that would be stressful for him.
For sure. He had watched the stock market fluctuate dramatically and felt like his retirement savings were at risk. So we discussed diversifying into REIT ETFs, and it was like a light bulb clicked for him.
Interesting. What made him lean towards that?
Well, he realized that investing in REITs could provide him with a steady income stream through dividends, which is something he really wanted for his retirement years. Plus, it gave him exposure to real estate without the hassle.
That sounds like a smart move. And it's so important to think about that steady income, especially as people move closer to retirement.
Exactly. It's about creating that financial security. Another thing I often see with investors in this age group is the emotional side of financial stability.
Oh, definitely. It's not just about numbers on a spreadsheet, right? It's about peace of mind and knowing that you're set for the future.
Yes. I had another client. Let's call her Lisa. She was in her late 40s and had been feeling the pressure of planning for her kids, college, and her own retirement. She wanted to ensure that she could provide for her family while also securing her future.
That's a tough balance to strike.
It really is. When we discussed REIT ETFs, she loved the idea that she could invest in real estate and still have liquidity if she needed it for her kids. Education. It was a win-win for her.
That's so smart. It really allows for flexibility.
Right? And with the current economic trends, more people are recognizing the value of diversifying their portfolios. The traditional stock market isn't the only game in town anymore, especially when you consider the potential for real estate to hedge against inflation.
Exactly. And it's not just about protecting what you have. It's also about growth.
Yes, and I think a lot of people over 40 are beginning to realize they may want to leave a legacy. Whether that's through real estate or other means, they want to ensure their loved ones are taken care of.
That's so true. And REIT ETFs can be a part of that strategy too.
Definitely. I've seen families who, invest together in REITs, which can be a really meaningful way to involve younger generations in financial planning.
Oh, I love that idea. It's like passing the baton, right?
Exactly. It's about teaching them the value of investing and building wealth, while also creating a safety net for themselves.
And as the market shifts, it's crucial for people to be adaptable in their investment strategies.
Yes, the landscape is constantly changing, and being open to new options like REIT ETFs can help safeguard against those shifts.
And that's where education comes in. The more informed people are, the better decisions they can make.
Absolutely. I often tell my clients that it's never too late to start learning about new investment strategies.
Yes, it's all part of the journey, And I think more people should feel empowered to explore these options, especially as they approach retirement.
Right. And the beauty of investing in REIT ETFs is you can get started with relatively low capital compared to buying a whole property.
That's a big plus. It opens the door for so many more people.
And it's also a great way to diversify without putting all your eggs in one basket.
Exactly. So, Mike, as we dive deeper into the strategies for investing in REIT ETFs, what should our listeners keep in mind?
Well, the first thing is understanding their risk tolerance and investment goals. It's really about aligning their investments with their long-term plans.
That makes complete sense. It's about finding the right balance between risk and reward, especially for those looking to secure their future.
Right, and then there's the importance of researching the different types of REITs and their performance.
Yes, each type has its own dynamics, and knowing the differences can really help in making informed decisions.
For sure, and we'll get into those specifics next. So, Sarah, when we talk about REIT ETFs, one of the first things that comes to mind is the importance of diversification, right?
Absolutely, Mike. It's like spreading your eggs across multiple baskets instead of putting them all in one.
Exactly. And with REIT ETFs, you get that built-in diversification. You're not just investing in one property or one type of property. You're kind of investing in a whole portfolio of real estate assets.
Right. So for someone over 40 who might be looking to build long-term wealth, what's a good starting point for understanding how to evaluate these investments?
Well, a great rule of thumb is the asterisk 1% rule. It's a quick way to gauge if a property is worth your time. You want to aim for properties that can generate at least 1% of the purchase price in monthly rent.
So if you're looking at a property that costs, say, $300,000, you'd want to see it bringing in at least $3,000 a month in rent?
Exactly. And this rule isn't set in stone, but it gives you a solid benchmark. It's particularly useful if you're considering properties to include in a REIT or an ETF.
That makes sense. And what about the asterisk 50% rule? Talk stray. I've heard a bit about that.
The 50% rule is another handy tool. It suggests that, on average, about 50% of your gross rental income will go toward operating expenses. So if you're projected to make $3,000 a month in rent, you should budget about $1,500 for expenses.
That's really practical. So let's say you're considering a property that fits the 1% rule and you're budgeting for expenses. How do you evaluate whether it's a good deal overall?
Great question. You'd want to look at the asterisk cap rate, 2 lies for capitalization rate. It's calculated by taking the net operating income, NOI, of the property and dividing it by the purchase price.
So if your property generates $3,000 a month in rent and your expenses are $1,500, your NOI would be $1,500. If you bought it for $300,000, your cap rate would be, 5%?
You got it. That's a solid cap rate, especially in markets where you're looking for consistent returns. Typically, a cap rate of 5% or more is pretty good.
And how does that help with REITs?
Well, when you're looking at REIT ETFs, you can apply the same principles. Check the cap rates of the underlying properties within the REIT. This gives you insight into how well the fund is performing relative to market standards.
That's a really good point. Are there other metrics or checklists you'd recommend folks keep in mind?
Sure. One practical checklist can include things like, is the property in a growing market? What's the vacancy rate like in that area? And, how does that REIT stack up against others in the same sector?
So it's not just about the numbers, but also the market dynamics?
Exactly. You want to look at trends, like population growth or job opportunities. A growing area is vital for long-term appreciation, and that applies to both direct real estate investments and REITs.
And speaking of appreciation, what about financing options? For someone transitioning into this space, what should they consider?
Great question. Traditional mortgages are common, but for REITs, you might be looking more at how the fund is financed. Many REITs use a mix of equity and debt to fund their properties. Understanding that balance can help you assess risk.
So if a REIT has a high level of debt, that could be risky?
Yes, exactly. High leverage can amplify returns, but it can also increase risk during downturns. You want to find a balance that feels comfortable for your risk tolerance.
That makes sense. And what about property types? Are there specific ones that are more appealing for a REIT investment?
Well, it really depends on market conditions, but generally, sectors like residential, commercial, and industrial all have their pros and cons. Residential tends to be more stable, while commercial can yield higher returns, but it's also more sensitive to economic cycles.
And then there are niche markets like healthcare or data centers, right?
Yes, those can be interesting too, especially as they're often less correlated with traditional market cycles. For example, healthcare REITs can provide stability because, people always need healthcare.
Right. And it sounds like each type has its own unique risks and rewards.
Exactly. So it's essential to do your research and maybe even get a little creative with your portfolio. Consider blending different types of REITs to buffer against market fluctuations.
So the key is to really understand what you're investing in, not just blindly following trends.
That's spot on. Knowledge is power in real estate investing. And as you're building your portfolio, always keep a close eye on the market conditions and how they might affect your investments.
Speaking of pitfalls, what are some common mistakes people make when getting into REIT ETFs or real estate investing in general?
There are a few. One big one is not doing enough due diligence. Some investors jump in without fully understanding the fund's underlying assets or the market conditions.
So it's crucial to really dive deep before pulling the trigger, huh?
Absolutely. Another pitfall is over-leveraging. Some folks get caught up in the promise of high returns and take on too much debt. It can be tempting, but it can lead to serious trouble if the market shifts.
And then there's also the emotional aspect, right?
Yes. Managing emotions is key. Real estate is a long-term game. You have to be prepared for ups and downs without making hasty decisions.
It sounds like a lot of these pitfalls come down to a lack of preparation or understanding.
Exactly. The more you educate yourself and stay informed, the better equipped you'll be to navigate the market successfully.
Well, that's some solid advice. Thanks, Mike.
Sarah, one of the biggest pitfalls I see investors make is over-leveraging. They get a bit too excited about potential returns and think they can push the envelope, right?
Absolutely. It's so tempting when you see properties that could generate great income. But when you stretch your finances too thin, it can lead to real trouble.
Right. I had a client once who was really eager to invest in a couple of properties at once. She took on so much debt that when one property didn't perform as expected, she found herself in a very tight spot.
That sounds stressful. What happened next?
Well, she ended up having to sell one of the properties at a loss just to cover her debts. It was a tough lesson, but it taught her the importance of maintaining a healthy debt-to-income ratio.
It's such a delicate balance, isn't it? I mean, you want to leverage your investments, but not to the point where it becomes a burden.
Exactly. And then there are those bad tenant situations. I think many overlook the importance of screening tenants properly.
Oh, for sure. It's not just about filling a vacancy. It's about finding the right fit for your property.
I had another case where a client was in a rush to rent out a unit. He skipped the thorough background check, thinking it would save time. Within a month, he was dealing with a tenant who was consistently late on rent and causing damage.
That's such a headache. It's like throwing money down the drain.
Exactly. And it took him months to evict the tenant, all while he was still paying the mortgage on that property.
That's a huge drain on cash flow, which brings me to another common mistake, ignoring cash flow.
Yes, some investors get so caught up in appreciation that they forget about the money coming in every month. I've seen people invest in properties that look great on paper, but have terrible cash flow.
I can see why that would happen. They get enamored with the idea of what the property could be worth down the line, but if it's not generating income now, it's a problem.
Exactly. There was this investor I worked with who bought a beautiful multifamily unit in a trendy neighborhood. The purchase price was high, but he didn't account for the high vacancy rates in that area.
So he was stuck paying for a property that wasn't bringing in much rent?
Yes, and he was constantly worried about how to cover the mortgage and other expenses. It really highlighted the need to do thorough market research, understand the area, the demand, and the cash flow potential.
It's about being realistic, not just hopeful.
Definitely. And then there's the issue of timing the market. Some investors think they can perfectly time their entry and exit points,
That can be such a dangerous game.
Right? I had a client who waited for what he thought was the perfect moment to buy into the market. But by the time he acted, prices had already skyrocketed.
And then he ended up paying way more than he initially intended.
Exactly. It's like trying to catch a falling knife. Instead, I always recommend focusing on long-term strategies.
That's such a good point. Instead of trying to predict the market, just invest wisely and hold on to your properties for the long haul.
And let's not forget about hidden costs. They can really sneak up on you.
For sure. People often underestimate maintenance costs or property management fees.
Yes, I had a friend who bought a rental property thinking he could handle everything himself. He didn't budget for things like repairs, insurance, or even property management if he ever decided to go that route.
So what happened?
Well, once the roof started leaking and he needed to fix the plumbing, he quickly realized how those costs add up. He ended up in a financial bind because he didn't factor in those expenses initially.
That's a tough lesson to learn.
It really is. And the key here is to do your homework. Create a detailed budget that includes all potential costs, even the unexpected ones.
It sounds like listening to your intuition is just as important as crunching the numbers.
Absolutely. If something feels off, it probably is. Trust your gut and don't ignore red flags.
So what are some signs investors should look out for?
Well, if a property has been on the market for a long time, that can be a red flag. Or if the seller seems overly eager to negotiate the price down.
And sometimes, if the property looks too good to be true, it probably is.
Exactly. Also, if you're not getting clear answers from a seller about the property's history, that can be a warning sign too.
Great advice, Mike. So what can investors do to recover from these pitfalls, or better yet, avoid them in the first place?
First and foremost, it's essential to educate yourself. Read up on market trends, attend workshops, and connect with experienced investors.
Networking can be so invaluable.
For sure, and always run the numbers before making any investment. Don't just go with your gut. Back it up with data.
And maybe even have a mentor or advisor who can guide you through the pitfalls.
Exactly. Having someone experienced can make a world of difference, especially when you're starting out.
So it's all about being informed, cautious, and taking a step back when things seem too rushed or uncertain.
Definitely. A good real estate investment is a marathon, not a sprint.
That's a perfect way to wrap this up. Let's move on to what our listeners can do next to set themselves up for success in their real estate journey.
So now that we've covered REIT ETFs and how they can diversify your portfolio, let's talk about some immediate steps listeners can take to start incorporating this strategy into their investing journey. Yeah.
Absolutely. I think the first thing folks can do is really just start with research. Dive into some online resources. Websites like Morningstar or Yahoo Finance can give you a good overview of various REIT ETFs and their performance.
Right. And if you haven't already, setting up a brokerage account is a huge step. Most of them are pretty user-friendly these days. You could look into platforms like Vanguard, Fidelity, or Charles Schwab. They often have tools and insights that can really help you make informed decisions.
And let's not forget about some handy apps. I'm a big fan of Zillow for property data, but for analyzing investments, you might want to check out BiggerPockets. Their calculator tool is super useful for investors at any level.
Definitely. And for those who want to get a little more detailed, DealCheck is another great app that helps you analyze properties and their potential returns. You can run the numbers on specific deals and see how they stack up.
Oh, and Rentometer is fantastic if you're looking at rental properties. It can give you a quick comparison of rental prices in a specific area, which is helpful for understanding market trends.
Yes, and if you're in the market for local insights, having access to your local MLS can be invaluable. It provides real-time data on property listings, sales, and market conditions.
That's a great point. And speaking of local resources, joining a local real estate meetup or investment club can also be really beneficial. It's a chance to network, share experiences, and learn from others who are on the same path as you.
Exactly. And don't underestimate the power of just analyzing one deal per week. It sounds simple, but if you commit to it, you'll build your analytical skills and gain more confidence over time.
Yeah, the key is to start small and build from there. And if you're feeling overwhelmed, maybe set a goal to read one book or listen to one podcast episode a week that focuses on real estate investing.
Great suggestion. Some books I recommend are The Book on Rental Property Investing by Brandon Turner and The ABCs of Real Estate Investing by Ken McElroy. Both are packed with practical tips.
For podcasts, you might want to check out Bigger Pockets Podcast or The Real Estate Guys radio show. They have a ton of valuable insights and interviews with successful investors.
And, establishing a routine can be really helpful too. Even if it's just dedicating 30 minutes a day to learning or analyzing deals, that consistent effort can pay off.
Absolutely, and it helps create a habit. You could also keep a journal of what you've learned or your thoughts on different investments. It's a great way to track your progress and clarify your thoughts.
Well, and don't forget to stay patient. Building wealth through real estate is a marathon, not a sprint. It might take time, but those small, consistent actions really do add up.
Exactly. And remember, you're not alone in this journey. There are communities and resources out there to support you. Just take that first step, and you'll find your way.
So those are some practical first steps. Now let's bring this all together. So, as we wrap up this episode, let's quickly recap some of the key takeaways about REIT ETFs.
Yeah, absolutely. First off, we talked about how REIT ETFs provide a great way to diversify your real estate investments without having to buy properties directly.
Right. And they allow you to access different sectors of real estate like commercial, residential, and healthcare, all in one investment, which is pretty powerful.
Definitely. And then there's the liquidity aspect. Unlike physical properties, you can buy and sell REIT ETFs easily, which gives you more flexibility.
Exactly. Plus, the potential for dividends is a huge draw, especially for those looking to generate income as part of their investment strategy.
And let's not forget the lower barrier to entry. You don't need a ton of capital to start investing in REIT ETFs, making it accessible for more people.
That's a good point. It really opens up opportunities for anyone looking to build wealth through real estate, regardless of their starting point.
For sure. So as we think about wealth building, remember that real estate can be a powerful tool. It's not just about buying properties. It's about making strategic decisions that align with your financial goals.
Absolutely. The journey to financial freedom can be made smoother with the right knowledge and resources.
And if you found today's episode helpful, we'd love for you to like, subscribe, and maybe even comment with your biggest takeaway or a question you might have.
Yeah, and don't forget to share this with someone over 40 who is also thinking about investing in property. You never know who might benefit from this information.
And next time, we'll dive into a really interesting topic, Delaware Statutory Trusts, or DSTs. It's a unique way to invest in real estate without the headaches of property management.
Sounds great. I can't wait to explore that further.
Me neither. Thanks for joining us today, everyone.
Yeah, we appreciate you spending your time with us. Until next time, take care and happy investing.